It's a tricky time for Indian markets. We're seeing a bit of a bounce back after over a week of weakness. But the question is, are we at an inflection point? We've had a fairly underwhelming second quarter of corporate results coming in. FIIs can't get to the exit door fast enough. And we still have to figure out what another 4 years of Mr. Trump as the US president means. In the middle of all of this, what is the outlook for markets? One of the clearest and I must say most candid voices with us today on NDTV Profit, Samir Arora, founder and fund manager at Helios Capital. Samir, always a pleasure to speak with you. Thank you so much for your time. And is it really as confusing as I've made it out to be in the introduction?
Actually, it is a little bit confusing, but not as much, because in the end, you have to drill it down to a few things, and we will do that here. But generally, in big picture, equity markets do well and you buy them when they have corrected a lot. And generally, all markets move plus minus together. You can underperform another market, but normally unless some specific negatives have happened, the markets don't turn negative and everything else is positive in the rest of the world. So it's simple things which define in the end the views on a market as far as I'm concerned.
No, so let's drill down then to one big, I think, concern, in quotes and quotes, is how Indian companies have performed in the second quarter of this year. Now, some will say that first half is usually tough, second half will be better. Some are saying varied weather, etc., monsoon, elections. Are you buying it, Samir? How are you seeing corporate performance?
So, Indian results have been quite bad, but they have been bad in 2 or 3 specific themes or sectors, and those have to be avoided. And we are not buying a correction or buying that their valuations have become okay in those sectors, because according to me, these things don't end in a quarter or two. So, for example, the 2 or 3 areas where there have been issues, number one in microfinance and small consumer loans and lending. And that has to be careful. And so you avoid that in future, at least means next 6 months, 9 months or whatever. The second, which I have anyway never liked, which is the auto sector, where worldwide you can see that there is still confusion about even how much EV adoption, whether you should subsidize it, and also the fact that there is so much investments made and things like that. So you don't know whether whose EV will be better than his IC, and generally a lot of capex required to remain in place, which is just to be able to adapt to the new technology. And the third one, which also broadly we have never liked, is this idea that in India, the consumers are growing and middle class is growing. Therefore, they'll keep buying TV, fridge and microwave ovens and air conditioners, because if there were 3 or 4 producers or suppliers before, now there are 20 people wanting to do the same thing, from all the retailers like Chroma and Reliance and all these guys wanting to do it, and then all the Koreans and Japanese and Chinese wanting to do it. And we also have this simple thumb rule: if there are not many big companies in the world in this sector, it's unlikely that in India there'll be some relatively big companies. So I don't know any big TV company in the world or any big fridge company in the world which anybody admires, looks at, or thinks of it as great return. So I don't want those things in India. These are my simple views on life. But IT is doing okay. Financials, otherwise, the private banks and all are doing okay. And these new platform time companies are doing okay. And in many of these, you are not really relying on end consumer growth. You are just relying on change of preference in the way you buy things. And therefore, those things can grow till you reach a point where the end growth also picks up. So there'll be more winners and more losers, but it doesn't mean that the market is bad, but it's not as straightforward as before.
Samir, here on this side, this is an interesting take where you're saying that completely, right now it's the best time to avoid auto, best time to avoid consumption. Then how are you putting your bets right now in terms of the new age companies? You have the likes of the Nykas, you have the likes of Swiggy's, Zomato's, which have come at play, right? Do you think they are actually posing a big competition to your traditional general trade and modern trade companies?
So first thing is, I'm not saying avoid consumption of all kinds. I was only talking about this consumer durable kind stuff, where although there might be demand, the supply or new manufacturers, new this thing are also very, very high. And also, as I said, separately, I also like to see that in the same business that there are successful companies in the world, and I can imagine that okay, this Indian fellow will do like that. For example, in the past, at one point there was a company which was trying to sell gym memberships. You know what, Talwarkar or whatever it was called in those days, and it had the same characteristics. Oh, middle class is growing, and people want to be fit. And I didn't buy it because I said, first, show me a big global gym company that has done well in life, because I don't want to be the first one discovering a theme which is so new that only India has it. Similarly, there was another company which is still there. We are selling timeshare and we are selling shared holiday homes. I said, first, show me a big global company which has done it. Because these things are not invented in India. And we know broadly these things haven't worked beyond a point. So I don't want them here. It's in that context I was saying that some parts of the consumer there are no successful companies in the world which are considered as top of their own market. So why in India we should do it? Now coming to the platform companies, and here I mean only the Zomato, Swiggy, or maybe PB FinTech, or even if you want to call Paytm types. Here the thing is that you are not overly relying on end growth of consumers being 10-15% per annum or something. You're only saying that the way that the way people are buying is different. So they are taking market share from another slower moving competitor. And therefore, we say that right now it is that preference of the customer which is giving us the growth. And over time, when that market share has stabilized between new and old, and whether you're buying online or you are taking delivery, or you want to go in this pollution and buy it yourself, then we'll rely on the end consumer growth.
I mean, Samir, an interesting one that you just mentioned about Talwarkar, is it making people stay fit? The companies become unfit altogether. So absolutely what you're saying.
Yeah.
But clearly, from the themes that we're looking at already right now, as you mentioned, you have some preferences coming in. What is the FI mood telling you currently? Because initially we were talking about FI money moving from India to China. Then we're talking about it's not China, probably it's the USA, right?
USA. Correct.
So how is that shift expected to happen from here now?
That shift also, big picture, must be somewhere near the end. So let's look at it. So there are, let's say, two kinds of investors, and I don't think there are three kinds. One would be a global investor who can invest in US, can invest in India, China, etc. And then there might be a investor like basically who can invest, or generally his fund is an emerging market fund or an Asia Pacific fund or Asia Japan fund or something like that. So if you're a global investor, your normal current weight in US will be more than 60 to 65%, because that is, let's say, big picture, the MSCI weight for USA in the world. And India's weight will be, I guess, 1%. Or maybe 1.5%. I don't even think 1.5%. So if you just look at it like that, somebody is saying, I have 60% already in USA and I have 1% in India. Oh, I must reduce because I want to increase my weight in US. So I'm making it 65.2% and reducing India to 0.8. Does it make any sense that beyond a point, this is not the trade? Because A, you have 33%, 34% in the rest of the world from where you can choose if India was otherwise doing well, which broadly I think it is still doing much better than other places other than US. And secondly, this move is for people who have these two things and who really think that 0.2% more is required in US. So by definition, this must be fast money kind of thing. Some money which is so focused on here and now. But even for this, the cost of this trade here onwards is more than 25%, which means in the last 1 month, say since October 1st, Indian market average stock that if these guys want to sell now may be down 10-15% or 10-12%. And in US, the stocks that they want to buy in this period are already up 10-12%. Or some big picture like that if you compare with the indices. So you have already a 25% difference because you now like US over India, if at all you like it to that extent. And therefore, from here, you should make another 20%. Looks very unrealistic to me. Therefore, I say plus minus a few weeks, this flow will finish. And it already seems to be reducing sharply from 4,000-5,000 crores a day to now maybe 2,000 crores, and let's see how it goes. But I think it'll end soon.
That's interesting, Samir. So you're saying in the next few weeks, maybe FII outflows, foreign investor outflows, taper off completely. But when are the inflows coming?
Plus minus zero. Yeah, which means taper off completely, I would say in another way. But that looks more dramatic than saying that it'll revert to what it is normally, which is that you start from zero and then you see whether it's up or down. But this trade will be over, that you are selling it to buy US.
Okay, but the question is, what are you selling to come to India, or when are you coming back to India? Because I think one thing which has become very clear is the narrative so far was domestic investors are holding up the Indian markets. Who cares about the FIIs? I think that reality check has sort of happened. That yes, FII money is important to the Indian markets as well. So maybe the selling tapers off. When is the money coming back?
You never know these things in that sense, except that overall the world continues to grow a little bit. So every year there's more money. See, please remember, if you look at 25 years or whatever of Indian FII experience, they would have put net money into the market in 20 of those years. I think this year also, I don't know. Now they may have turned negative, or maybe not. But otherwise, in the prior to this year, they were negative only in 4 years in history, which were 2008, 11, 18, and 22. So it is not normal to be taking out money because, some X% money goes to emerging markets for some pension funds or big endowment type. They're rebalancing that if US has gone up so much, then we'll take 1% off and put it into India, China, whatever. What I mean is, it is not only that a market going up keeps getting money, and actually India overall has been doing well. Plus, also understand that even if you say 60% US is doing well and they are 60% or 65% invested, they have 35% from where our weight will be 1%. So for us to be kept constant at 1 or made 1.2 doesn't need some great thing that US has to do badly. Broadly speaking, countries which are doing well get money because there is always new. Let's say the world is growing at 2.5-3% GDP. That means X% is the savings. Say it's 5% of that, whatever be the amount. But every year the world grows, and every year the AUMs grow, and every year flows grow. And India may not be the best country in the world to invest, but it is not so bad that you should take out of India to put in other markets other than US. And the US is not that the US market will stop going up. But it's not that our market is the only funding market that is there in the world. There's no reason for it because we may not be the best market. We are, let us say, the 5th best market now in terms of attractiveness, not in terms of size.
Yeah.
So I don't automatically mean that India is the funding market for the rest of the world. Doesn't make sense.
Okay. So at some point, FIIs will come back. But let's talk about domestic money, Samir, because now you have this interesting perspective of the aspirations of Indian savers who have seen some excellent years. And now are you sensing some concern about what is happening to their funds or their portfolios? Or is that confidence still continuing? Are you finding it difficult to manage these funds and really bring back those returns right now?
No, so right now returns will be lower than previous years, I guess. But the flows are not stopping, although we are one of the new smaller AMCs.
Yeah.
But we also get money every day from 300-400 investors. Now, all these big guys might be getting from 30,000 a day, but we get from 300-400 to 500-600 people every day coming and investing money. And out of that, some 35-40% is direct. So how did they discover us? From where did they think about us? And these are maybe from more than 400 cities or small places, whatever, they're still cities. So it is quite amazing the depth to which this has gone. And if they look at their accounts for this year, but if they look at it for calendar year, which is how I look at it, maybe because I'm not looking at the April year and they might look at it a little differently. But broadly speaking, they are up 15-20% even this year. A calendar year, at least 20% plus in our case. And therefore, I don't see that they will worry so much that in October and November, these good funds have lost, say, 3-5% or 5-6%. And I don't think it is. And anyway, today looks like a day when it seems to be at least giving back some of it, getting back some of it. So I don't think that people will be shocked, because really anybody who's put in money even for 6-9 months is not below his cost. So right now, I don't think it will stop, because it is not that deep. And anyway, the market and the investors are programmed right now, including me, to buy a correction. If you fail 2-3 times on buying a correction, then you don't do it. But right now, it's like the total time is about 35 or say 40-45 days, in which you have lost maybe 20% or 25% of this year's gains and retaining everything else from previous years. So I don't think right now anybody is going to feel totally nervous about it. In fact, my feeling is, and my view is, that as soon as the FIIs stop a little bit, even if temporarily, this market will go up 3-4% and make everybody climb back, saying now it is over, because that is the recent experience. And only if the recent experience fails 2-3 times, then you will try and find a new formula.
Samir, if you're sitting on cash right now, best time to actually deploy it for an Indian investor? And if so, which are the sectors or bets that you would advise?
So first of all, we have in all our funds nearly fully invested. I myself personally, over and above being a large investor in my funds, I had some cash and I invested last Friday, not this Friday, previous Friday, 3 days after, the 2 days, the day after the US guys cut interest rates. And I think from a big picture, every market is a buy, whether it is India, China, US, or gold. And I bought all the four on that day also. And coming to our funds, we are 98-99% invested in my long short fund. After this correction, my net exposure, which on average over 19 years is 63%. If I look at month and average, right now it'll be more like 78-80% net, because I am really going in with you can say all chips in for a year-end rally and for a stopping of this FII selling. But now the question is what stocks to buy. So we are not buying any stock which has disappointed this quarter, even if the stock has fallen 10%, 15%, on the basis that these things don't stop in 3-6 months. It is better to buy stocks that are doing well, even if they are up 5-7%. In the next 6-9 months, we think that there will be a shortage of very high growth names, which also we all need. And therefore, our first group, where we cumulatively have maybe 14, something 12-15%, is all these 4 platform companies, which are Zomato, Swiggy, PB Fintech, and Paytm. And rest, we will buy only stocks.
Samir, what's the pecking order? What's the pecking order of these 4?
Pecking order is only Zomato is a real big one. Other 3 are maybe 2.5-3% each. So together, but Zomato, because it's gone up 5-6 times for us, or 5 times, it has become some 6%. So others will be 2.5% each. Maybe Paytm is 3.5-4%. That also because we made serious money on it. So, but the point is not the pecking order. The point is the concept. The concept is that there will be a shortage in the near future. And we need, not for the whole portfolio, but for 10, 15, 20% of the portfolio, you need something growing 25-30% at a sustainable rate for at least 2-3 years. At least you can imagine that. Then whether it happens or not, we'll see. But it is very boring to buy a company in consumer staple which has disappointed and therefore fell 5%, but its earning growth will now be 4% and its valuations have gone from 55 times to 52 times or 48 times. Doesn't excite me. It didn't excite me before and it doesn't excite me now. And one reason why we are willing to play this is because in October, in my offshore hedge fund, actually I was up when the market was down 7.5%. So we are saying let's just play a second round of it and raise the net to the level that we have.
A quick question I have on that is a D-Mart or your new age platform companies like a Zomato or a Swiggy?
No D-Mart. D-Mart is too expensive and we've not had it. After a few, maybe from May of 20, we've not had it. Because the thing is right now, as I said, we are going with the momentum of results right now. Then if that changes, we can buy, because what do you miss in the time that, where the turn happens? You will miss a 7-8% move at that day. But if that happens, then you will see for continuously that company doing well for 3-4 years, 2 years. Look at it. We also have some loser companies. So we own Westlife. So Westlife, it disappointed one quarter. We said, no, it's okay. Then it disappointed. Then it disappointed. Now it's 7 quarters that is disappointed. And we still say, okay, we have it now. What to do? What I mean is, once you have it, you can, you sort of keep it or whatever you do. But what I mean by big picture is that I think when things do well, they go on for too long. And when things go badly, they go on for too long. And then there is one turning point. And you can't buy for that turning point, and when it suddenly has a better result, or in some case a worse result, that day you will either make or lose 5-10%. Let it be. After that, you do what you want. So, but sometimes you're already in a stock and therefore you don't know, you just sort of give it more time. But there is no need to average any guy not doing well right now.
Okay.
It's just not worth it. That's what I feel.
How do you feel? So, how do you feel about a Trent? And Samir, are you surprised at all with what happened to Honasa?
So, everybody says we are not supposed to talk about individual stocks, but in this case, we are not short or long. So we can say that Honasa, not surprised, but Trent, we have not, we can say we have missed it, and now it's too late to buy all these stocks which are trading at 100 times PE or whatever.
Just want to know how you're feeling about the IPOs, Samir. I mean, NTPC Green is the latest one. Are you feeling now a little less bullish about IPOs than I think the market was viewing it 6 months ago? And any view on this particular one?
So I have broadly not been bullish on IPOs, and at least as an advice to others, because as your viewer, which is, let's say, the retail public, they are not going to get any unless they think that, okay, they made 5,000 rupees because they retail that. I don't relate that much. I'm saying in general, you don't get IPOs that are hot and good because they get oversubscribed so much. So the only IPO you get will be the one which has failed more or less. So in the end, IPOs don't make money for anybody. Even for the anchors, they don't make money. If you look at the fact that, I mean, they don't change anybody's life. I shouldn't say they don't make money. For example, even the biggest fund, let's say HDFC or all these massive funds, even if they get 50, 100 crores in an anchor and on that they make 25 crores, I don't think it changes their NAV by even 0.1%. So in the end, IPOs are, still people buy. Some of them we also want, some of them generally just to be in the game. But I don't think IPOs have made any difference to anybody's returns ever.
Samir, your quick view on the PSU dividend policy that has been now revised after 8 years. How are you looking at it from an investment perspective, specifically, for the PSUs?
No, we are not looking at it because the dividends were previously also okay. Now you might have a little more, but we being growth investors don't look at it like that. On the PSUs, otherwise we used to have more before the elections, and now we have less because we sold off the railway PSUs and one bank PSU and reduced the defense, and some of our funds eliminated those stocks also, on the basis that they had very massive runs for the previous 2-3 years. And for that to be sustained, needed continuous reinforcement by government in terms of announcements and orders and contracts and general, in some cases, like in the oil and gas, some privatization dreams, and all those got a little bit shaken up at that time. So now we have much less. Basically, we have State Bank and one or two more.
So, Samir, just a couple of things, before we sign off this wonderful conversation with you, is would you at this point invest fresh money to buy the dip, or you would wait and watch? And how important, in your view, is the outcome of the Maharashtra elections, which where voting starts on 20th?
I know that election is a bit confusing, and that could move it a little bit up and down, saying, oh, the BJP has not won. So that is okay, different, and I don't know how to anticipate it or analyze it. Otherwise, we buy every day. Every day we get money, every day we buy. We don't keep any cash because, as I said, not only not keep cash in our fund where we can do long, short, and change our net much more than in a mutual fund. Our net from an average of 63 is currently, I think, 78 or something.
Right. Samir, a quick rapid fire that we're going to do with you for the next 90 seconds. One Bollywood...
90 seconds be rapid fire. That means you are asking 30 questions or what?
No. So I need you to sing one Bollywood song that best describes the market mood today.
Oh God, that is not rapid fire. I'm listening more to Badshah and all. So
You're listening to Badshah?
These days I don't see Hindi movies. They're not. I mean, I don't see that many good movies. No, I don't know.
Any song that describes the market mood.
Okay, you ask me the next question. This will go in the back of my mind.
Okay, Samir, if you had to put money afresh, would you bet on Trump's America right now or China's resurgence? Of course, India is the evergreen bet, but between the two.
So as I said, I bought both on the assumption that Trump will not really hike tariffs across the board. If you see all the fellows that they are considering for Treasury Secretary, they're all finance guys, whether the CEO of Cantor Fitzgerald or that Apollo founder Mark Rowan or that hedge fund manager, that George Soros' CIO, what is his name, Besant, and there was another guy. So all these guys are actually from the finance field and investments field, and they would also know how far you can go. So I think China will not be that bad. But currently, pure momentum, it's US, but both are good, I think.
Okay. Large caps or small caps right now, and would banks top your list?
Large caps and banks.
Which bank? Private, public? Which is your top banking pick right now?
HDFC Bank.
Okay, good and solid. What about IT? Will IT go up or down in Trump's Raj?
Go up. Because the thing is, IT is more to do with US companies doing well and their confidence in investing in technology and other things. The fact that you get your green card or not doesn't really matter. It matters to that poor individual and his life being uncertain. But you know how markets work. Markets don't care whether you went on H1 or you did it in India or you went there and got a green card or you got a visa for your wife. All these things are individual stories, not for the way the stock markets work or the corporate sector works. So in the end, I think if the US guys are doing well, that is US companies, potential clients, actual clients, then you will do well.
Right. So Samir, that's going to be an interesting one, but we're going to still wonder what's that song going to be that was going to relate with the markets as well. And probably, I think, is it going to be time for people to go for holidays as well, and how Europe is going to pan out for you. So that's Samir Arora, founder and fund manager at Helios Capital. Tamanna, clearly, money is expected to come back to the Indian markets. How and when is the key now, and how that money is going to pan out, because another upside from here on is what the investors are going to wait for.
What I found very interesting is, Samir got away with not singing a song for you, but what I found very interesting is Samir Arora saying that in the couple of days after the Fed cut, he was completely invested.
Absolutely, and he only has almost 95 to 99% invested.
Yeah, absolutely. So great conversation there with Samir Arora. That's all the time we have on Profit Insights. Thank you so much for watching.